Reaction from Kristen Bitterly, head of investments for North America at Citi Global Wealth. Kristen, how would you characterize what you're seeing in front of you right now?
Yeah, I think there's a lot of things to look at. But ultimately, I think that financial stability depends upon public confidence in financial institutions. So the comments around sentiment, panic is a very powerful fundamental that doesn't need a rational basis to have influence on financial conditions and influence the economy. And I think the other debate right now that's going on is this idea of price stability and financial stability, looking at the Fed's mandate. And those two things can't really be neatly separated from one another because the tools used to address one have implications for the other.
What do you think investors should do in an environment like this?
So we have, our views from the beginning of this year when we released our outlook for 2023. One of the key points of that was not fighting the Fed, and the baseline thesis that tightening financial conditions are going to create a contraction, whether that's in the economy or whether that's in earnings. And so looking throughout our portfolios, what we have been doing is playing a lot of defense for that reason, because the cumulative impact of what the Fed has done, this idea of going from 0 to 4.5% in such a short period of time after coming off of zero bound rates for a very, very long period of time, almost the past decade, has to have implications for the economy and corporations. And so from a portfolio positioning standpoint, well, it sounds boring. We have been overweight quality fixed income. We have had positions within U.S. government debt. We have also been leaning into quality within equity portfolios as well. And I'm happy to go into more details. But I think the volatility that we've seen in the market year to date, with the market really trying to latch on to different narratives about disinflationary forces or inflationary forces, and we've seen that really play out in the rates market, we've been sticking to our guns in terms of this defensive positioning.
Okay, well, let's go a step deeper, Kristen, because you mentioned at least some interest in equities right now. But where? Last hour, we heard from the Bloomberg opinion columnist John Authers, who noted one of the challenges for, let's say, bank investors right now is that even though there's been government support, there's been support for depositors. And the message to date has been, well, we're not going to bail out investors in equity portions of banks. So there's a lot of skittishness out there. What are the kinds of sectors within equities that you're looking at? Are you looking at banks? Are you looking elsewhere?
Yeah, so I think the challenge in terms of banks, just from a profitability standpoint, right? Not a liquidity standpoint, is this idea that with the yield curve inversion and what's that's done, and you have to look at some of those leading indicators, that makes the profitability question a lot more challenging. The need to take on more loan loss reserves given what we're seeing, as well as this idea that lending conditions are going to become tighter on the back of this. I think that's what many people feel. So I think from a broader equity standpoint, where do you want to be invested? You want to be invested in some of the more defensive parts of the market and those areas that have been able to grow their earnings throughout prior recessions. You've heard me talk a lot about healthcare and global pharmaceuticals, where strong free cash flow generation and this ability to grow earnings to the tune of about 8% per annum during the prior 4 recessions that we've seen. Anything with durable demand, dividend growers are another area. And again, this goes back to some of the fundamentals in companies where you have strong management, you have strong free cash flow generation, this consistent ability to not only grow dividends, but also grow earnings through various cycles. That has largely been our positioning within equity markets, and we're maintaining that.
Before I let you go, you talked about that challenge in fighting the Fed. The complication now is, what exactly are we fighting? We've got a Fed decision next week. What do you think the Fed's going to say and do?
So this is the challenge. What do we want them to do versus what they are going to do? This debate about price stability and financial stability and what's happened. We always say that the Fed has a dual mandate, right, in terms of full employment and price stability, but financial stability is also very critical and important. I think given that we still do have their concern around inflation, and particularly within the core areas of inflation and the non-shelter services, still remain pretty high. I think that there's a decent probability that we do see 25 basis points, but we will see as the market continues to react to everything that's happening more from a financial stability standpoint, what they decide to do.
All right.